Hi, good evening, everybody. Welcome. So, we are back with the latest edition of Netra for the month of October. So, before we start, I'll try and set the context for the next half hour, what Sahir is going to talk about. So, this month's report is sectioned into two categories. In the first category, in the first section, we focus on, if you've all read the report, you'll know we'll talk about the strategy of multi asset and how it has performed across markets and over the long period, which we take 20 years. The second is that one asset class which has beaten the equity performance of almost all emerging markets. And lastly, what does the current cycle mean in terms of the exuberance it has created and how far this can be sustained? In the second section, we talk about various pockets of opportunity across sectors and across markets. So before we start, just as a note, you guys have a question answer tab on your screens below. So you can put in your questions through the course of the presentation and we will take it towards the end of the presentation. Thank you. Over to you, Sai.
Thank you. Thank you, Pragati, and thank you everyone for joining in. And as you know that we publish DSP Netra 5th of every month. And the idea is to bring to you insights which will help you take a better investment decision. So this time we have, highlighted a number of very, very important data points which are visible throughout markets. And we would, like to understand that these data points can help you take very, very important decisions because markets are always at a juncture where some decisions can, allow you to have a much better investing experience over time. So, as Pragati said, today's session is divided into two parts. First is on multi-assets, the winner's curse, and the current cycle, and then we'll talk about some opportunities. So, first is a very important way to think about investing is the portfolio approach. Usually, what happens is when you have a very long duration bull market in equities, for example, in India, over the last 20 years, you had only two declining years or three declining years in equities. And what does it do is it allows people to have a very benign and positive view about equity markets because they deliver significantly superior returns. And equities become an overarching proportion of your portfolio. But the idea is to have equity mix with other assets to make your portfolio more robust. So we looked at a number of countries across the world and we did an exercise looking at what are the multi-asset allocation returns across the world. So if you look at the chart on your screen, you will see that emerging markets as a basket over the last 20 years have delivered 4.8% dollar CAGR returns, right? And when you mix equity, debt, international equity, and gold together, you can see the multi-asset returns are 6.7%, which is approximately 200 basis points higher than just equity returns. This is aggregate of all emerging markets. When it comes to India, when it comes to China, Thailand, Pakistan, Japan, US, UK, you can take another 30, 40, all markets individually or put together. You'll find that multi-asset allocation has delivered significant returns across the world. So it's not a one-trick pony or a strategy which works only in one country. It has worked across the world. And what are the reasons for it? One is that it has exposure to international equity, which diversifies you away from only domestic equity. For example, in case of India, rather than buying only Indian equity, you are also exposed to international equity and you are also exposed to gold. If you note carefully, you will find that these two asset classes help you protect against currency depreciation. And within emerging markets, currency depreciation is a big problem. And in most emerging markets, currencies depreciate either because of government policies, because of war, because of inflation, because of many other reasons which are unforeseen. For some developed markets, because they have much stronger institutional structure, depreciation is a lot lesser, and therefore their overall return profile follows through from equity and debt, right? But in case of emerging market, it is very clear currency depreciation plays a very large part. So when you look at this slide on your screen, there are two very clear takeaways. One, multi-asset allocation allows you to earn, let's say, equity minus kind of returns or close to equity returns. In most cases, multi-asset allocation returns are actually higher than domestic equity returns. But when you look at the volatility of these portfolios, it is much lower than equity volatility, which means that a multi-asset allocation portfolio allows you to uh, enjoy good experience, better returns at a lower volatility. Okay, and this is what the crux of the matter is, that it's a much superior strategy. Also, please note very carefully that except India and US, in most countries, multi-asset allocation returns are higher than domestic equity. Even for India, if you take certain periods, for example, a 2019 or a 20 crash or a 2011 to 13 period, you will find that multi-asset allocation returns are superior than equity returns. So it's a bit more cyclical, but in most countries, it has worked very well. The next slide is an extension of what we are saying in this slide, which is particularly about gold. Okay. And gold is often an asset class which comes into fashion only when it delivers. So over the last 10 years in dollar terms, gold hasn't delivered very high returns. Only in the last 3 to 4 months, it has seen a rally. Prior to that, it was at a 0% 10-year CAGR, right? And only because of the rally, $500 rally in the last 6 months, has the returns come about. Otherwise, the returns were much lower. But when it comes to emerging market, you can see that gold beats domestic equity markets in local currency terms in almost all emerging markets. You can see we put a number of emerging markets here. You can put more emerging markets, and whichever frontier markets qualify, you will see that gold returns in domestic currency. What does domestic currency mean? When you talk about Turkey, we are talking about Turkish lira returns for gold and for Turkish stocks, right? In that manner, for example, a person sitting in Turkey investing in gold and in equity would have made more returns in gold than in equity. This is what we mean by local currency returns. In India, the number is 1.5 percentage points lower for gold, but it is also cyclical. There were cycles in which gold was slightly ahead of equity, for example, in 2017, end of 2017. And similarly, there are cycles when equities are ahead, but you can see that in most emerging markets, gold has outperformed. And what is the reason? The reason again is that uh, domestic currency depreciation helps gold prices move higher. Gold is inversely correlated to currencies. So, for example, in domestic, let's say Indian rupee terms, if rupee depreciates, gold prices go up significantly, right? And it is true for all emerging markets, or for that matter, any country, even for United States, right? So this is the reason why gold is priced as money. And we'll try to look at how do we value gold when we move ahead. One key conclusion from the slide and from the last two slides. One, equity is not the only game in town. There are other asset classes which, if mixed appropriately, will give you a better investing experience, particularly gold, which has a very solid track record across all emerging markets, including in India. And we think that adding this to the portfolio becomes a meaningful bet. And from a multi-asset standpoint, as a strategy, any strategy which does not have sizable or meaningful exposure to gold, and which only has, let's say, 10% regulatory exposure, would be doing a disservice to the overall portfolio at various points in cycle. Of course, there will be cycles when you only need less exposure because prices would have already rallied. But in the longer term scheme of things, a multi-asset allocation needs to have the ability to hold higher amounts of other assets, which is international equity and gold. So, conclusion from these two slides is diversify. The next is what we call the winner's curse, which is more cyclical in nature. And why we are showing this data? What is the data first? So we have divided the last 3 decades into 10-year each, 1 decade each, from 94 to 2004, 2004 to 14, and then 14 to 24. And when you look at the performance of various country equity markets, you will find that the winners keep changing. For example, from 94 to 2004, United States delivered very high returns, and then Philippines was at the last spot. Then Philippines jumped to the number one spot. Indonesia, which was second last, jumped to the second spot. India, which was middling, came to third. And US, which was a clear winner, went much lower, right? And similarly, from 2004 to 14, you again see large changes. There are two persisting factors, two countries. US has repeated twice in the top three, and India also has repeated twice in the top three in these two eras. Apart from them, most other countries have been more cyclical. One very important idea is that winners keep rotating. It's not that one single market will continue to deliver outsized returns over time. And second is what I've written as the title, the winner's curse. What is the winner's curse? When auctions happen, there are a lot of bidders there, and when the value of that thing which is being bid is uncertain, the winning party usually ends up bidding the asset to an overpriced level. Because they want to win, they will keep on bidding the price higher, right? And eventually they will acquire the asset at an overinflated price, which will cause the future return of the asset to go down. This is called winner's curse, which means that even after winning the auction, you end up buying an asset which is overpriced. And this is what has caused these rotations, where when equity markets performed brilliantly, people became more excited. They bought more of those markets, either domestic investors or FIIs, and they ended up holding an overpriced assets. And that is why these rotations happen. And as you can see that the two largest and best performing markets are US and India in this cycle. We don't have any forecast to make whether these country can continue in the top two to three buckets. Maybe they can continue if they can continue to deliver very high earnings growth, but the odds are stacked. Odds are stacked against these repetitions, and usually assets which are much more cheaper. For example, what we saw, what happened in China over the last 10 days, have the ability, have the optionality to do much better because A, they're under-owned and they're also undervalued, right? And I have written a comment here that history shows that there are no new eras and there are only cycles. Okay, and impermanence always prevails, which means that most trends are impermanent in nature. Right? They by the virtue of mean reversion, you will see that these rotations will continue to happen. The next is again a very similar concept. It talks about the outperformance of Indian equities versus emerging markets. So when you look at the chart on your screen, you will find three lines here. And let me magnify this so that it is much more visible to all of you. And when you look at this chart, the red line here is the MSCI Emerging Market Index divided by S&P 500. So when the red line is rising, that means emerging markets are doing better than US. They are outperforming the United States equities. And the blue line here is India, which is MSCI India divided by S&P 500. So when the blue line goes up, India is outperforming. You can see that in most instances, India was behaving very similar to all other emerging markets, right? And somewhere in 2013-14, we started to move ahead, then again fell in line in terms of correlation. But post-COVID, you can see very clearly, India has remarkably outperformed all other emerging markets. And the biggest differentiator has been the large underperformance of China, going out of Russia, large underperformance of Brazil, etc. And that has caused the red line to go down relative to S&P 500 while India goes up. Okay. How low is this red line? You can see that it is already lower than the 98, 2000, 2001 lows that we saw, which means that emerging markets are cheaper versus the US market than they were 25 years ago. In fact, after making this chart, I looked at the data going back to 1960s, and this line is at its lowest level since 1969, which is roughly 55-year low for emerging markets versus United States. Okay. And India, on the other hand, is at its second highest cyclical peak versus US market. So you can now make a comparison that in terms of outperformance, the only time we were performing better was in the 2007 to 11 GFC crisis era. We were performing better than US. And this is the relative ratio. And what is the difference between emerging market performance and India's performance? The CAGR relative difference is 18.2% CAGR on a 4-year rolling basis, which is the highest that we've seen in 27 years since the data is available. Now, these are all stats. What does it mean? The premium that we have that India has over emerging market is very, very high. Okay, which means that it is going to be very difficult to sustain this premium unless our earnings growth outpaces emerging market earning growth like it has for the last 4 years. So for emerging markets, the earning growth has been lower single digit. For India, it has been 20% plus. If this differential continues, that means if emerging markets continue to see lower single digit earnings growth and India continues to see 20% plus growth, maybe this divergence will continue, right? But it is not. As you already know that there is some uptick happening in other EMs and some slowdown in Indian earnings. So this wide gulf that you see right now on the screen is bound to close, right? How will it close? I have no clue. Whether it will close with time or it will close with price, that is anybody's guess. There is another insight in this chart. A lot of people over the specifically last 8 days, are now talking about that a decline in dollar will cause Chinese equities to move higher. Okay. And the reason that is being given is that when dollar declines, commodities go up. When commodities go up, China does well. Okay. And this is the first level thinking. Most likely, this thinking may not play out. Okay. I don't have a crystal ball, but the driver of outperformance of China when dollar declined with commodities was the real estate sector, okay, and the industrial sector. Both these sectors are struggling in China. Even if there is an economic stimulus, the biggest beneficiary in China from economic stimulus is going to be the consumer sector and the technology sector. Those are the sectors in China which will, uh, you know, get benefited a lot more. So if there is a dollar decline, the most cheaply priced sectors in China, which have the possibility of higher growth, will be tech, consumers, etc. And I don't think that they have any strong correlation with the dollar, right? And therefore, Chinese equities may perform on their own, but they have very little to do with what the dollar is doing, right? And therefore, this correlation may be a spurious correlation going forward, although it appears very robust on charts, right? If you put a technical Excel sheet put together and do a correlation, you'll find a brilliant correlation. But the underlying causation behind this um, movement is more or less already broken because the underlying paradigm has shifted. The causation factors have shifted. And therefore, we believe that this gap that you see here is close to closing and maybe converging as we move ahead. And when will it converge? Anybody's guess. But I think it's more important to know what will converge rather than knowing when will converge, right? We need to know what the odds are rather than to know when will they play out, because knowing when is almost impossible, but knowing what are the odds is not very difficult, right? You can put them together where extremities lie, and I've already showed you where the extremities are. So it is only a matter of time where this gap bridges and it converges, and we think that maybe it has already started to some extent. The next slide talks about a myth that has been there in the market for some time, which is that large FI flows and large mutual fund flows has caused a permanent bump in the market, and money sitting on the sidelines will not allow the market to fall, or more and more flows will allow the market to rise. And we have shown multiple data points over the last 6 months showcasing why this is a flawed logic. Here is one more attempt of doing the same thing. So if you look at the upper panel, it has FI flows and mutual fund flows. If you look carefully, very large flows from institution, which is FIs and mutual funds, to the tune of about $86 billion have come in the last 18 to 20 months. Okay. And in the last 18 to 20 months is the time where Indian markets have been at its premium valuation, specifically in the last 6 months, right? The large flows that you see, all these flows have come into a point where markets are at a premium valuation versus its own history, which means that, and they were also at very high CAGR returns, right? The short-term returns were very high, which means that even institutional money, whether you call it retail or institutional, I don't know the color of the money, it is also chasing returns. It is not causing returns to go up, it is actually chasing these returns which have come in, which means that when you see the biggest downtick here, which is 2020, mutual funds net purchase of equity in 2020, which was the cheapest level for Indian equity in over 15 years, was net negative in that year, which means that when equity markets were extremely cheap, mutual funds were net sellers. Mutual funds are nothing but an expression of money that they are receiving. So if they receive 100 rupees, they will have to put maybe, let's say, at least 96 rupees in the market. They might hold some 5% cash, but the rest of it has to be put into equity by the virtue of the design that they have. So it's an expression of investor interest. FPIs, on the other hand, are more choosy. When do they want to enter? When do they want to exit? But even for that matter, you will see that most FPIs chase returns rather than causing them. And this is very clear that, and maybe one hint here, imagine the large flow of money which has happened in the market has happened when the markets were at rich valuations or higher valuations. What kind of returns will higher valuations offer this money, this 86 billion inflow? It will not be same as when the valuations were low. It will be much lower, right? So maybe think about it this way, that if you buy an asset at its most expensive level, or at least let's say the top quartile level, the ability of that asset to give you high returns falls, right? And this is what is happening with institutional flows. The second myth which is there is that if China loses FII flows, India gains, which means that if there are outflows happening from China, India will have inflows. And this uh, myth has been repeated very strongly over the last 7, 8 days, where people have repeatedly said, or you are hearing and reading, that because China has gone up, India is seeing outflows, right? There is a rebalancing happening and flows are moving to China. They are moving out of India, etc. You might look at the daily data and maybe arrive at this conclusion, but look at the long-term data. This is FI portfolio equity flows, and this is FI equity flows into India. The blue line is FI is putting money in India, and the black line is FI is putting money globally in equities. You can see how closely they move with each other, which means that any downtick in global FI money, there is a downtick in India, right? And seldom it happens that the trend reverses, where if FIs are selling globally, they will buy in India. It's a very rare occurrence, right? Maybe you could state a 2020 kind of a scenario where net FI flows were lower than the last year, but Indian flows were higher, right? And if you eliminate two very large deals from Facebook and Google for Reliance, this number will actually fall, right? Which means that net, India receives higher flows when other markets are also receiving flows. Okay, so put it correctly in the correct context. If China does well and FIs want to buy emerging markets, India will get more flows. Okay, which means that uh, because most of these flows are passive in nature, they follow MSCI Emerging Market Index. When FIs or foreign investors have a positive view on emerging markets, they will put 100 rupees or $100 in EMs. India and China will get their weightage, their share. If they have a negative view on EMs, they will pull out money. So irrespective of what the local market is doing, that passive flow, inflow or outflow will happen. So therefore, if there is a good global environment, India benefits from that. It is helped by such an environment. It cushions market decline rather than forcing it, right? And once again, FIs cannot set the direction of the market. They are mostly chasers. When FI do well, when equities do well, they line up. So, for example, over the last 8 days, when Chinese market went up 50%, global brokerage houses started opening demat accounts for investors in China. Before that, there was no activity, right? It is purely price inspired. As of 20th September, nobody was talking about China. The moment the equity market rallied, you see all the activity going around. And this is what reflexivity does, right? So, two myths. One, that institutional flows cause returns, that if more people are buying, it will go up. Maybe in the short term, for a few months, it can happen, but they do not dictate the long term returns for equity markets. Rather, it is the opposite. When flows are very high, longer term returns actually fall. Okay. And there are many other statistical ways to think about it. For example, if a lot of money is chasing equities and the volatility falls, And the lower volatile asset technically should earn lower return, not higher. Okay, so that also tells you that why higher flows eventually causes lower returns, not more. And similarly, FI flows are more dictated by where the returns are coming, and a benign global environment where FIs are positive on emerging market helps our flows, not the other way around. So the best way to think about is that if China is doing well, Brazil is doing well, other emerging markets are receiving flows, India will get a higher share. India will do much better, right? Which means that if there is a flow for emerging markets, India will benefit from it. The next slide talks about a very important matrix where we took out data looking at how investors have participated in Indian equity markets. So we've put out three charts here. First is the upper panel, which talks about the number of demat accounts. You can see in March 2020, we had 4 crore demat accounts. As of June 24, we have 16 crore demat accounts. So 12 crore demat accounts have been added over the last 4.5 years, which means that out of this 16 crores, 12 crore accounts came in just last 4.5 years, which means 75% of these demat accounts have never seen a bear market in their accounts. Similarly, when you look at the folios, what are the number of folios that has been added in mutual funds? You can see large cap folios have increased from about 1 crore to 1.4 crore, so a 40% increase. But small cap folios have increased from 50 lakhs to 2 crores. So now small cap folios are higher than large cap folios. They used to be half of them, now they are higher than large cap folios. And you can see that all the folio addition happened where they overtook large cap folios happened in the last 18 months. You can see that 1 crore folios were added between March 23 and June 24, right? In this 15-16 months era, right? And this is where small caps became the most expensive that they have been on record. And we are doing an exercise where we will share results that when you buy any particular segment of the market, when it is in the top decile or top quartile, the ability of that market to deliver past returns is much lower. And you can see that all these folios, all these demat accounts have come at a time when valuations are much richer when they were not present in the market. Plus, they've also not seen very large declines. So how will they behave when these large declines happen is going to be a very, very critical ingredient of how markets will function going ahead. Okay, and why we are putting out this data? Because a lot of our own investors fall into this bucket where they have started investing new post-COVID or in the last 2 years or last 3 years. One point of caution is to review your asset allocation very, very with a very critical eye. And second is to not over own equities. It is much better to be more diversified or at least be in hybrid funds like a DAF or an ESF or these category of funds which are more diversified in nature rather than holding just small and mid caps 100% of your value. Or if you are a direct equity investor, you should rethink about your equity allocation of how much that resides in a particular bucket. The next is unsettling calm. We have used it over the last 4-5 months, indicating various parameters. Some of them you can go back and look at some of our earlier Netra webinars. You will find many of them. This time, what we are measuring is the distance from 200-day average. So when you look at the daily movement of Nifty, if you just average the closing price of Nifty on a daily basis and see where it is trading now. So currently Nifty is trading almost 12% away from 200 DMA. This is data as of end of September. And it has spent more than 370 days away above the 200 DMA. Okay. So what does these two reading tell you? That it has spent enormous amount of time away from 200-day average. Okay. 200-day average is nothing but a smoothened time series, right? It tells you how the market is moving. Over time, we note two trends. First is that when markets bottom out and they rally, they go far away from 200 DMA. So, for example, look at the 2003 move. When the market recovered, it went up 50% away from 200 DMA. Similarly, when the 2008 crash happened and recovery happened, market went up 40% away from 200 EMA. And similarly, when COVID crash happened, markets recovered, they went up 30% away from 200 EMA, higher than 200 EMA. But one point to note is that every subsequent rise, okay, which is higher, but the distance from 200 DMA keeps decreasing before the market then corrects, right? What is the intensity of correction is unknown, but this pattern repeats every time, which means that the market uprise becomes shallower and shallower as the market matures over time. And we are seeing very similar trends play out where rise are becoming shallower and possibly they have become one of the most shallowest that we've seen in recent trends, which means that 200 DM is catching up. What is the conclusion? That market rise from a momentum basis, which has been the dominant factor over the last 4 years, is giving up, which means that the rate of change is slowing down, which is one indication that market can take a correction or a consolidation, and we have seen some amount of it, or at least initial single tick happen over the last 4 5 days. I don't know whether it is to call it a correction or not, because the price move is very very small. But one thing is very clear that rate of change is slowing down, which indicates that you might see a probability of correction going up much faster. The next is the funding mechanism in the financial markets. Uh, you can see that fundraising has become actually very very easy in India. Equity capital raising is at record high. You can see these red bars. Corporate bond issuance is at record high. Bank credit accretion is also at a record high. ECB's also made a record high. In fact, IPOs are now at the highest level that we've seen ever in India, right? So all these numbers are excellent. They are very positive. It tells you that corporates are able to raise resources very easily. It makes a lot of sense to corporate to raise money. But it also happens, these easy money environment also tends to happen at the best time, which means that when all conditions are extremely favorable, capital raise becomes very, very easy. This is what is happening right now. Okay, and this is also one of the reasons why equity markets have done really well, because fundraising has been extremely easy. We have no idea whether it will become tough to raise funds or not. As of now, it is easy. We are seeing some initial hiccups in IPOs, but two things are happening. One, increasingly IPOs are being offered at very high valuations, right? Which makes them very tough to make money going ahead. And second, number of issuances are also going up significantly, right? Which makes them raise capital, which is going to be much more harder to make return for the investors. And I think this is possibly a peak of times when uh, corporations or promoters are able to capitalize on investor exuberance, where investors are more than happy to offer money and promoters are more than happy to offload their stake, right? And this is what is happening across all funding lines. So one of the expressions of that same funding is a chart which we prepared even in the last edition, where we showed that 23% of small and mid cap promoters have diluted their equity stake. This time we've shown how much have they diluted. So we in this chart we've taken estimate which we have calculated. This is not the exact data, but it is very close to what it should be. And according to our calculations, almost 1.4 lakh crores of equity dilution happened in the last 12 months, which is an all-time high. We haven't seen this kind of equity dilution happen ever. Okay. We have a 20-year data, but even if you go back, the numbers will be much lower in earlier cycles because the size of the market was lower. So if you compare it to, let's say, as a percentage of total market cap or any other measure, we are far, far away from any peak that we've seen earlier, which means that promoters are much more agile and ready to offload equity because valuations are very, very, very superior. So, for example, think about a promoter who's able to sell his stock at 40 times or 80 times or 100 times multiple, for which to justify that valuations, he will have to show an earnings growth in excess of 50%, which is almost impossible, right? So many of the investors which do not have the long-term vision or they are in it to sell it, they are more than happy to offload the stake, and which also makes equity issuances go up and ability of investors to make money on those issuances go down significantly, right? So this was the first section which talks about the overall overarching effects in the market. Section 2 will talk about some opportunities. First is tech. Chinese technology has been on our radar for the last 10 months or so, and we've had a positive view on a number of Chinese stocks and some additions in some of our strategies also way back in March and Feb. But over the last 8 days, we've seen a large rally. And one way to think about Chinese stocks is to think about Chinese technology. And if you look at these three tables we prepared, one which shows China's tech share, US technology companies, and Indian tech. And we've compared some important numbers. You can see the average multiple for Chinese tech is just about under 17 times. For American companies, it's 48. If you aggregate it from market cap, it will be about 36 times, and similar number for India, 36 or so. But look at the cash that these companies are holding. Before the rally of the last 8 days, when we were preparing this slide, all Chinese technology companies were available at $1 trillion market cap. They have rallied now. They were holding 30% cash as a percentage of their market cap. While for India, that number is 5%, for US, that number is 3.3%. So it does not mean that American companies are inferior. They are actually much more superior in terms of fundamentals and performance and cash flows. There is no doubt about it. But Chinese companies, the amount of cash that they hold, held an optionality and they still do so. They continue to remain much more cheaper even after the rally that we've seen over the last 4 or 5 months. So we believe that when you think about various sectors which are very comparable globally, you will see that a lot of opportunities will exist. One way to exercise these opportunities is to go through a strategy which can buy these international stocks. It's not possible to own them in Indian domestic equity oriented strategies. You will have to go to hybrids or global fund of fund categories to capitalize on them. So we think that there is still value by the virtue of cash that these companies hold. But we again think that the best way to participate, let's say in a China type story or some other jurisdiction, is to play through strategies which are non-financials, because you don't know what kind of risks are hidden there. Particularly in case of China, non-financial, non-industrial, and non-real estate portfolio, we think will do a lot of sense. The next slide is how to value gold and silver. And this is a theoretical concept. It is not a definitive concept. Let me put that disclaimer. And gold prices do not follow this pricing that we are showing here. It is one way to think about how to price gold, right? So on the left-hand side, we have seen what is the total mined gold. Total mined gold, which is above ground, is about 2.12 lakh tons. If you convert it to billion troy ounce, it will come to about 6.83 billion troy ounce. Now you take the US money supply. The reason is one assumption. We are assuming that gold is money. And if you take US money supply, the reason that we are taking US money supply is A, US is the reserve currency, US dollar. B, we are pricing gold in dollars, and therefore we are taking that number. So the monetary base is about $21,000. Okay. And that, if you divide $21,000 with 6.83, you come to a price of $3,072. So this is a rough estimate of gold price, what it should be based on US money supply. But you also have one more reserve currency, which is euro, and half of euro central banks hold gold and USD, right? So their own FX reserves are made up of gold and euro. So if you eliminate that number, you take only half of EU money supply, which is $7,500 billion. It is actually 15 to 16 trillion dollars. We've taken half of that, right? We've taken 7,500 billion to account for EU money supply. If you take this number, EU will add another $1,000 to gold price, which means that gold price should vary between $3,000 to $4,200. Okay, this should be the rough estimate of how to think about gold. And now, if you take a simple gold silver ratio, because it is very hard to think about silver in terms of just money, but if you were to think about gold and silver and take a derivative price of silver, Gold price and silver price have moved together for a long time, but in various varying degrees. So silver to gold ratio has varied for a very long time. We have used the gold silver ratio here. You can see it has moved. It was as low as 9.4 at some point in time, but in the 21st century, it has been 60 is to 1. Currently, it is at 84. Okay. So, which means that if this 84 ratio was to go to 60, silver price should be priced between $50 to $70, 51 to 69.5. Currently, it trades somewhere close to 31 and a half. So we believe that there is a lot more comfort in both gold and silver basis this theoretical exercise. This by no means gives you a target price, but it gives you what is the potentiality for both the precious metals, and we continue to hold a positive opinion on these two assets. Next again is how debt or huge debt binge globally. You can see the left-hand side scale. This is the 5-year CAGR in US debt and 5-year CAGR in gold price. Both have moved together. You can see US continues to take more and more debt, which also makes us more optimistic that gold price will continue to adjust higher because global currency debasement is not ending anytime soon. The right hand side chart shows you that whenever there is a bull market in precious metal, okay, silver outperforms gold. This is silver to gold ratio. Whenever the red line goes into a bull market, the gray lines outperforms, right? Currently, that outperformance hasn't happened, and therefore that also makes the case that we believe that silver could be a bet which could outperform gold if the bull market continues, and we are already in a bull market. So silver is a good contender given the risk reward that it offers. The next is two sectors from domestic equity. First is banks. So you can see that banks, when you put all banks together and look at their profits, and when you compare it to all companies in NSE 500 and look at the profits, banks account for 25% of overall profits, right? While their market capitalization is only 12%, right? At one point, they had higher market capitalization than the profits that they had, right? You can see that that number persisted for a small time, largely because of PSU banks. But in totality, their profit share has always been high, close to 20%, but now it has gone to 25%, while their market cap share, which was 14%, has fallen to 12%. So, which means that banks continues to be one of the sectors which is underowned and also undervalued, or at least close to average valuations, and therefore we continue to hold a positive view on the banking sector. The next is play between consumer staples and consumer discretionary. What are consumer staples? FMCG companies where the products of these companies are consumed whether there is a recession, slowdown, or euphoria, or great times, like a toothpaste or a soap, right? These things do not see negative growth very easily. They continue to either see strong growth or less growth. The other side is consumer discretionary, for example, an automobile sector or a brown goods sector, where these products are consumed when this disposable income is high or the consumer is feeling good, their demand goes up, right? So over the last few years, consumer discretionary stocks like autos have outperformed staples by a very wide margin. Currently, the ratio has come to a point where it is at its historical low, and it has already started to reverse. If you remember, we showed this trend first time in Feb 2024 edition of DSP Netra, where we had initial signs that this ratio is beginning to turn. And the reason was that consumer staple companies had started to report end of deterioration in their margins and in their volumes. So they have started to report stable numbers, not growth, but stable numbers. So now we think that this is probably possibly a time where staples can do well, and also know that staples are a more defensive sector. They do very well when the markets are choppy or declining. You can see staples outperform consumer discretionary by a very wide margin, and it happens repeatedly, right? And for example, even during the COVID era or the small decline, time frame decline that we had, staples did very well. So this again is a opportunity where staples could do well versus consumer discretionary. We've held auto for a very long time. We had a positive view on autos for almost 3 years, 3.5 years now. Slowly we pared it down, reduced it, and we think that staples could be a good replacement. The last is slide is on passive indices. We think that there is a lot of chasing of two particular factors, which is alpha and momentum. And we looked at a bunch of categories where passive smart beta products were available. So two very, very important points to note. When you look at an index performance, you don't get the index performance. You get the performance of the underlying fund. That fund has an expense, which is called TER. It also has a tracking error. For example, when you buy and sell an index, you pay commission cost. You also pay slippages. So, for example, if a stock is available at 100 rupees, that was the last traded price. When you bid that stock, you might bid it at 100.1, right? So that zero point 0.1 becomes a slippage if you don't get it at 0.1. The seller offers you at a higher price, right? So that difference becomes an expense, and that causes your returns to be different from the index returns. Now, many of the passive funds which show very high alpha when you backtest them, but when you go and invest in them, you will find they have very high TERs. So some of the smart beta funds in the industry, particularly in the alpha and momentum category, have TERs ranging from 1% to 3%. Okay. So which takes away a large part of alpha that you see when you look at the backtested results. And therefore, we believe that one of the more stable categories where these differentials are lower is the quality factor. You can see that the TER or the slippages are much lower for quality at 0.7 versus a momentum or a alpha, which is at 1.4, right? And this makes a lot of difference because chasing, looking at only the past performance may not be the best way to select even a passive fund because um, high churn usually subtracts returns. So when you see that a strategy is making a lot of money by churning a lot, uh, there are no free lunches. Eventually, that high churn can cause A, tracking differences, B, it can also cause more losses. That era has not happened as of now, and therefore it is very hard to envisage or believe that such a strategy can have losses. But when market conditions become adverse, order book, maybe a phrase that you will hear more often in the next 2 years, becomes a big problem, right? And therefore, it is very, very important to select even passive funds where A, maybe the churn is low and they solve for quality of businesses, not only thinking about price, right? If the factor is solving for quality of the business, it becomes a much more attractive factor to bet on. This does not mean that momentum or alpha is a bad quality factor. It is one of the best factors. It has performed very well over the last 20 years. Even in fact, even globally, over the last 50 years, it has been one of the best performing factors globally. But it has its own cycles, and we need to understand those cycles very, very well. Right? So with this, I will try to conclude and put together what we've discussed. So three, four ideas we've discussed very clearly. One, multi-asset is the way to go. Keeping gold in the mix is very, very important. Winners keep changing. So betting that same type of strategy, country, index will continue to do well may not be the most appropriate factor. India's outperformance is at risk. While other emerging markets play catch up, we might actually slow down. And flows do not create returns, they actually chase them. And we are better off with a global benign environment where returns are coming in, and very few investors have seen a bear market where we stand today. So a behavioral test may come up. Uh, there is continues to be unsettling calm. Volatility remains very low, which is a factor which can play out with investors which haven't faced volatility. So their behavior can decide future course of action and maybe short-term valuations also. Raising funds is very cheap, and that is causing a lot of promoters to dilute equity by raising a lot of funds and giving equity to eager buyers at valuations which are not very conducive. And then in the second portion, we discuss about equities, particularly technology, gold and silver, how gold and silver are still very attractive, and two sectors, banking and staples, where we think opportunities are abundant. And last, how do you play the factor funds, keep a focus on funds which are solving for business quality. So with this, I will end here.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.